Hey guys, welcome back. In today's video, we are talking about the sinking ships of short, the Citadel 1 trillion swaps, shorts over leveraged, and many more in this video. I want to start this video off and taking a look at this picture. AMC retails are holding strong and adding the longer this drags on. The trapped short sellers are taking on water, where what we're looking at is a very obvious picture. The shorts are obviously in the boat that's filled with water that's slowly filling up, and at one point it's obviously going to sink, and that's exactly what's happening right now. You can see the sharks are obviously the retail where we are starting to take control, and it's of course been a very long journey, but with everything we've seen now, when you take a look at the water in the boat, it's essentially taking a look at the synthetics, the naked shorts, the liquidity, the over leveraged positions that they have, and it will make sense as we break it through into this video. Firstly, you can see here why does Citadel Security Swap Dealer LLC have $1 trillion worth of leveraged derivatives on their balance sheet. So this is taking a look firstly at the Citadel Security Swap. And so already we're talking about one of the short sellers that's of course in the boat. And you can see that we are going to be talking about Citadel, we're going to be talking about Susquehanna, and we of course already know about Credit Suisse, and you could even add in UBS in there. And the reason with Credit Suisse is we already know, of course, with their swaps position, and you can see how it's already ended up for them. And the only reason why they're still able to still exist is obviously because of UBS and other forms of capital that's being supported to them. But what we see right now is, how do you have nearly 1 trillion in derivative contracts, but less than $500 million in cash? Where we're obviously taking a look at the Citadel report on the Citadel Security Swaps Dealer LLC. And so when we take a look at Citadel, something that we already know is that in the past, we already know how much Citadel has in terms of their short position, over $65 billion. Now, what's even more important is understanding that loads of their positions, their assets are all carried over and are using loans. We talked about how some of the positions, they based it off of the 2021 going to 2022, and then they based it off of 2022 going to 2023, and so on and so forth. And we also know that Citadel is of course taking up a lot of loans because they need the money, whether it's to pay out to the investors, whether it's to continue to aid their current positions, to obviously fulfill the margin requirements. You know, those are what's being taken away in terms of what we have seen from Citadel. And so they are obviously not in a good position. And if you want to look further, you can see, holy shit, Susquehanna Securities is reporting their total net assets at 364.7 million, while having 1.66 trillion in derivative exposure. So another short seller with an extremely high derivative exposure. And we, like we said, we're breaking down in terms of the shorts that are obviously taking a toll. And some shorts that are obviously not mentioned in this picture, but everyone understands as well. You know, we have the likes of Virtue. When you want to include other institutions like Goldman Sachs, who obviously spoofs and have shorted AMC in the past, they are all in these positions because we've covered in the previous videos. Goldman Sachs, all of these top banks, they have trillions in derivative exposure. Now we're seeing the same with Citadel. Now we're seeing the same with Susquehanna. And so what you can see is that many of the short sellers of AMC, of GME, they are all in a position where they took in a massive risk. Now, of course, not all 1.66 trillion is in AMC, is in GME, and that's something that everyone understands. But like we've mentioned in the past, what it does mean is that firstly, they have a lot of capital, they have a lot of synthetics tied up in AMC and GME. And it's precisely because of that, is obviously posing a threat towards their capital, towards their liquidity. And the reason why that's bad is because the liquidity that they have right now, it's used to maintain the 1.66 trillion, is used to maintain the 1 trillion in swaps, or to be exact, what we are seeing right now, 944. It's what they're being used to maintain. But when the situation with AMC becomes too big, when AMC goes up to $1,000 per share, to $5,000 per share, and they no longer have the liquidity to fulfill all their positions, when they have to use all their money to buy back the shares of AMC, to buy back the shares of GME, you can just imagine what will happen to the 1.66 trillion, what will happen to the 1 trillion. And that's why they constantly feel the need. You can even see, like we talked about here, why they feel the need to, of course, always suppress AMC. Why they can't allow AMC and GME to go up in value, because it will be the last straw to, of course, the stack, and that's what they don't want. And like we've said, AMC, like we've seen in the past, I said, is tied up to $1 trillion market where easily it could tumble. We've seen this mentioned in the news in the past before. And this is the very reason why, because it isn't just going to be one firm. Remember, when this ship sinks, it isn't just the one particular firm. It isn't just going to be Credit Suisse. It isn't just going to be Citadel, but it's going to be everyone that's involved. And it's much more than everyone that you're seeing in the picture right now. And that's why they need to obviously maintain it. And you can see, here's the kicker. The majority of Citadel's near 1 trillion in derivative contracts, which are interest rate contracts, are OTC cleared, meaning the swap contracts were done over the counter in private with a bank and cleared by clearinghouse, either LCH London Clearinghouse, which Citadel uses for their swaps, or CME Group, the Chicago Mercantile Exchange. And so what we are looking at is where they are at. And so, like you said, the reason we talked about Bank of America in the past is understanding that Bank of America is obviously the prime lender for Citadel. And we've seen that in the filings in the past before, that Bank of America, at any point where they deem a positions to be too risky, do they deem that, you know, their liquidity is going to get dried up, that Citadel don't have the ability to pay back, they will recall the loans. They will have the right to, of course, also cancel their positions, because that's what they use as collaterals. And so we can see that these over-the-counter positions that are with banks, you can see how firstly is tied up. And so this is what we talked about with how it isn't just the one institution that's involved, but rather the whole group is a massive groups of different institutions that are out there that are tied up. And that's why they want to help one another. But when the situation becomes too big, they're obviously going to throw each other under the bus. They're obviously only going to try and rescue themselves. And that's when everything will, of course, crumble down. And so that's obviously what we are seeing. And a big reason to why we're also mentioning this, and you can see why it's becoming more and more risky and undiscovered, Citadel is over leveraged 944 billion on yen carry trade and is ready to blow up. DFV figured it out a year ago. So this is, of course, still talking about the derivatives that we talked about. And what we are seeing is, of course, the breakdown in terms of why this is happening, why they have these positions, and of course, with the yen carry trade and linking everything up. Now, again, I highly suggest anyone to take a look at this, because it will give you a deeper insight, a deeper understanding of everything that's going on. It will allow you to understand why shorts are struggling for liquidity, why shorts are, of course, in a position where they can't afford to have the risky positions to go up in price, why we've seen recently why Citadel was forced to close over leverage positions is because of everything that's crumbling down. We're seeing what's happening in the market. We're seeing of all these caveats that is being shown to us right now with, of course, the potential market crash. Obviously, in the last few weeks, we've seen how the stock market has dropped. You know, over $1 trillion in value has been lost. And these all relate with how much money these short sellers gain access to. And that's why they need to, of course, keep it all under control. And you can even see how Citadel and Virtue can be defeated at the DTCC level. This is how it will most likely play out. Buy and hold DRS shares. The shares to borrow dry up. Market makers and DTCC can't settle their short sales. Market makers start posting more collateral and rolling fails at bigger rates. Big company news like a merger, buyback, or digital ledger is released. Price spikes and all the short positions go deep into red. DTCC tells Citadel and Virtue to post more collaterals, and Citadel and Virtue can't, since the apes did not participate in the stock market or any market for them to get access to liquidity, and then they become insolvent. So it's obviously what we have seen in the past. Now, again, I know some people may, of course, have second thoughts about DRS, but what you want to look at it is that essentially, and this isn't to say that you should DRS, but another way of looking at it is that any way that prevents shares being lent out, that prevents real shares to be used as a way of creating synthetics. And so it isn't just DRS, it's any method that's out there that prevents these shorts from doing that. it will cause the short to have difficulties to borrow shares, to create shares, and therefore it will provide difficulty for them to obviously suppress the price. And of course, when that happens, what we are going to be seeing is that as all these collaterals fail, the market is going to go down, but AMC and GME will go up, whether it's because of merger, buyback, or any other sort of factors. And when that happens, obviously we see that Citadel and Virtue will start to lose money. And if they need to maintain the short positions, they will need to post more collaterals. But if they're not making money from other places, then it's all going to go down into flames. And that's when the retail will win. But yeah, guys, thanks for watching this video. I'll catch you guys next time.